Hi guys, risk management, everybody's favorite subject. So what we're going to do is we're going to cover all different ways of approaching risk management, how you deal with risk within a trade, how you approach risk from the perspective of your daily risk, and also how you approach risk over the longer term. So we're going to look at all different parts of it. Now, of course, the first thing to be thinking about when it comes to risk is a daily stop, and that's where we're going to start. But one thing before we do start, risk management is not just about minimizing losses. Risk management is also about understanding when the appropriate time is to add to winners, to take on more risk. Don't see risk as something that is there to be minimized. Losses are there to be minimized, but risk isn't just about losses. Risk is about taking on a possibility of losing in exchange for a possibility of winning. That's what risk is all about. So, without further ado, first thing we're going to get to is, from a daily perspective, daily stops, daily targets. Now, this is something that people don't always have. And often I know that people do have daily targets and they don't like a daily stop. So what I'm going to try and illustrate here is what the value of having a daily stop is to start with. And the real value of a daily stop is that what it allows you to do is not get yourself into a hole. One of the worst things that you can do in trading is have a situation where what you lose on a day requires multiple days to recover. Because what this now does is it puts pressure on getting a sequence of profitable days. If you have another down day in between that, then you add more profitable days to this sequence to a point that you can end up with an implausible number of profitable days required to dig yourself out of a hole. So that's what it's there to prevent you from doing. The other thing that a daily stop does, and this again is where people don't always think about risk, by limiting your downside on a day, what you're giving yourself is the ability to make the upside more forceful, if you will. If you can limit your downside and you let your upside go, then what ends up happening is, even if you have a losing day, the impact of that losing day is much more limited simply because you've minimized the amount of downside that you're going to take on a losing day. And that's also the argument for why you shouldn't have a daily target. A daily target means that down days effectively hurt more because they're not being countered by larger up days. So let's go and have a look. We'll get onto this example in just a moment. But in a rough sense, setting a daily stop can be a relatively simplistic thing. Now, for most people that we take on, we would suggest your daily stop is going to have to be at least $500 to give you enough space to move when you're trading futures. There's no point in minimizing this too much. And no, I'm not going to talk about percentages here. We're going to look at numbers. 500 would be a minimum stop. But the other way to do this, and this is about making it personal to you, your daily stop should be equal to or less than a median average up day. So what I mean by this is, what is a typical up day? Don't average them out by creating a mean average, taking account of your really big upside, because that could give you an average up day that's actually higher than what you realistically can consistently achieve. The point here being, you don't want to lose more money than you could recover the following day. That's the way you've got to try and think about it. Could I recover this the next day? So strip out all of your extreme performances. If you have a one standout up day, one standout down day, don't include those. And you're looking for the middle ground. Hence why we use a median average there, not a mean. And another way to think about this, to think about realistic performance as well, is something that I was told by a trader quite a few years back, that one of his simplistic approaches is to assume what he calls a 3-1-1 week. That within a week, you will have 3 up days, 1 stop out day and 1 flat day. So what this means then is that your real profitability on any week is approximately 2 times an average up day. So that also gives you a sense of what you need to be aiming to achieve if you want to achieve X amount per annum, for example. It's very easy to look at things in averages and say, well, I can average £500 up day, therefore I make 2.5 grand a week, 10 grand a month, 120 grand a year. But realistically, if you can make 500 on an average up day, you're realistically only going to be able to make 1,000 a week. That's the way to think about that in terms of your performance. Now, let's go and have a look at this. I've used simplistic numbers here as an example, rather than this is real numbers. I will then show you real numbers afterwards. But what we've got here then is theoretical P&L and then plotted on a chart. So what we've got is P&L and cumulative P&L with a stop. Cumulative P&L. So what this is then going to show you is, if you don't have a stop, what you end up with is, let's say that you end up with minus $2,000 on down days, or £2,000, whatever you want to use. We're using simplistic numbers. Now, exactly the same performance day by day by day, so same win rate or win rate on days, but by allowing yourself to lose 2,000 on a down day, what you end up with is a cumulative performance that is much, much lower. You end up down here. Even if you do manage to pull out a $1,000 update at the end of the month, this cannot recover the losses because you're getting burnt by these big down days that come in here. This is what the blues are. Those blue histograms are your P&L per day. In this example, with a stop though, look at those red histograms. You're not seeing the big downside swings. So by having more up days than down days, you do get this consistent performance over time. So limiting your downside is crucial. Now, if you can achieve a $2,000 update, you can have a $2,000 downside. That's absolutely fine, as long as you're managing to achieve a 311, or indeed, you're able to have a bigger than $2,000 update. So think about your daily stop. Your daily stop is vital. It stops you digging yourself a hole. It stops you getting into a situation where you're going to need an implausible number of up days to be able to recover a sequence of losses. So that's daily stops in a basic sense. We can talk about this in the later session. Targets. Often people look at a target and think, well, if I have a daily target, I stop, I bank the money. You can't lose money if you keep on banking it. And no, that is true. But over the long term, what happens is if you limit your upside, you only need one down day that can take all of this away. If you have a limitless upside, what you end up with then is a situation where the downside, when it comes, you have your down day and you stop out, this doesn't pull you back very far. I've used real numbers here to give an example. This is 3 months worth of trade, June, July, August 2022, for around about 25 traders in the office total. What I've done then is break down performance and given theoretical stop on the day, theoretical target on the day. The blue line here is actual performance over that period of time. Now, if you added some extra bits into this, if you had a stop, so this would be a daily stop on those traders as a whole of $200,000 on a day. So if they hit that, that's it. No more trading for the day. If they had a daily stop and no upside target, that is the performance that you would achieve. So you see, by having no target but a stop, you improve performance overall. If you have a stop and a target, you're limiting your downside, you're also limiting your upside. So the fact that this group of traders overall is consistently profitable, by limiting the upside to a target the same as the downside, so a matching target and stop, they're able still to achieve more up days than down days, which is giving you this performance. And that's the point. If you have an upside target that equals a downside target, or a downside stop, I should say, then the only way that you get performance is by having more up days than down days. Whereas if you can have excessive, if you will, up days, you don't need as many to be able to counter a few down days. And finally, if you have a target but no stop, so basically this is including the worst down days but limiting the up days to 200,000, this is what you get, the red line. And over that period of time, by having a target, limiting your upside, essentially, you actually end up with negative performance because the downside hurts you. The downside takes that away and you're limiting your upside. So yes, the idea seems good that if you keep taking profits, you don't go broke taking profits, as they say. The problem is, over time, this can happen, particularly if you don't have a downside stop. So crucial to think about that. One way that I've had this explained to me, and I think this adds up very, very well, is what I call taxi driver logic. And the explanation is basically, if you have a target as a taxi driver, there are going to be certain days that it's very easy to achieve that target. Think of a particularly rainy, cold day. If you have a $300 target to achieve driving a taxi, you will achieve this very quickly because everybody wants a taxi on a rainy, cold day. On a nice, warm, sunny day, people don't want taxis and they're happy to walk. You're going to find it a lot harder to achieve that target. So what you're going to end up with is if you have the target of $300, you are going to work a huge amount on a nice sunny day when you could be out doing stuff with your family. And you're going to work very little on a horrible rainy day and then go home to stay in on a horrible rainy day. So basically, by having a target, what you're doing is you're taking away the good stuff and leaving yourself with the bad stuff in the taxi driver logic. The more appropriate way to do it will be to work as hard as you possibly can, as long hours as you can on the rainy days, achieve 1,200, 1,500 on those days, and if you make 150 on a sunny day, it doesn't matter because you've achieved so much more upside on the rainy day. Basically, if a day is running for you, if the opportunities are coming your way and you understand that day well, this is where to make the most of it. Don't limit yourself because you don't know when the next day like that is going to be coming around. I think this illustrates it very, very well here. Particularly the idea of having a target. If you have a target on the day, over time, this is actually detrimental more so than not having a stop. Right then, how do we manage these things then on a day-to-day basis? So this is one of the hard decisions of, well, how do you stay within that stop? Now, one of the easy ways to do this, and perhaps one of the more attractive ways to do this, is what I would call a loss-based management strategy. Now, what a loss-based management strategy does or involves is setting yourself a monetary amount for any one trade. So let's say you give yourself a $200 stop on a trade. What this means is that you need to then adjust size to enable you to stay within that boundary. The bigger the stop on the trade, the smaller the size executed in order to stay within a $200 boundary, 300, 500, whatever the number is that you assign to a trade. Now, the key to using a strategy like this is stop placement, and stops being placed where you are genuinely wrong. Because it's very easy to increase size on a trade. Let's say you take a $200 stop and you say to yourself, well, if I just give this a 2-tick stop, I can trade a 10 lot. Now, if anybody's looked at gold, and you will have over the recent weeks, you could say, well, I'll trade 10 lots of gold with a 2-tick stop. Therefore, I've given myself a $200 loss and I'm on for a big winner in gold. The reality of that, of course, is that a 2-tick stop in gold is not going to be sufficient. So it doesn't justify a 10 lot being traded. So the key to this is that the stop has to be placed where you are wrong. And with any stop, that's the thing that you must ask yourself. And as we go through this week and we look at game planning, we look at routine, and we look at all of those other aspects, always ask yourself with any stop, is this where I am wrong? Because if it's not where you're wrong, it's the wrong place for a stop. Now, this does have some very, very distinct advantages. The obvious of which is it allows you to increase size without risking a larger loss. If you have a situation where your stop can be minimized and is genuinely not very big, then you of course can increase your size. But what this does is this puts a relationship between the size of your stop and the size that you're trading, rather than whether you really believe that this is a good idea. But nevertheless, that is one of the advantages. The other thing that you can do is you can take your daily stop and divide this out nice and easy. If you've got a $600 daily stop, you can divide that down. 3 trades of $200 risk. If you get 3 wrong in a row, then of course you're stopped out for the day. But you can then very easily apportion your risk to trades. That's the advantage that this type of strategy gives you. Now, the disadvantage, of course, is that you could be presented with a perfectly good trade, an excellent looking trade, and not be able to take it. Because if you set yourself a $200 risk and the trade requires a 25 tick stop, for example, in a market that is $10 a tick, you can't take the trade on. So it becomes prohibitive and can actually limit your ability to take very, very high quality trades, simply because you've defined an amount that you're willing to lose on a trade. The other thing that it can do is it can encourage what I would call lower quality trades. Cheap trades, basically. That the smaller the stop, you will put more risk on a trade. Now, just because you have a small stop doesn't mean the trade is likely to work. So what you're then in fact doing is taking a trade that has a relatively low chance of working, or let's say 55-45 chance of working, it's a slightly positive chance of working, but put more size on that trade because it's cheap to do so. So don't look at a stop and see a stop as cheap and so therefore you can take more size on. You want to look at the opportunity in terms of, is this a viable chance and does this have a high probability of working? Is this a high quality trade rather than just simply a cheap trade? Remember, something's only a bargain if you think it's a good idea to start with and happens to be cheap. Something being cheap is not necessarily a bargain. So, the other thing to remember is that losses aren't a bad thing. by always trying to minimize loss, and this is often a focus for many people when they start trading, the focus is on just don't lose. Just try and minimize losses. Losses aren't a bad thing. They give you a huge amount of information. What you should be trying to do is minimize low quality trades. So this gives you a base to start from. And there has to be an appreciation of the amount of monetary loss within a trade that you're taking on. Even the best trades. If you can't afford to take that trade on, then it is not a viable trade for you. It's not as simple as saying, well, the trade looks good, it makes a lot of sense. If you can't do that within your daily risk, then you have to step back and say, this is not for me. It's too expensive. So there is value in understanding a loss-based management, but to apply this in every situation does have its downsides. Let's go and take a look. Right, what we've got here, structurally exactly the same trade. This is a trade in Euro stocks done around about 4 months apart, almost to the day. So exactly the same situation. We've had market sells off, we get test of the low. That creates this level. It's also here over here as well. Break through the low, false break, retest of the original low. There's your entry point. You're using an old level that has been false broken as your support to essentially play back through what is almost a kind of head and shoulders pattern, or at least to play it back to the top of this range if you want to look at it in that way. So what's the difference between the two trades? Well, the first trade, you buy at 01, your stop's at 96. So that's a 5-tick stop and you've got a 67-tick target. Now looking at this trade, what you can do is you can take this trade on with 4 contracts. That affords you the 5-tick stop. And so there you go, loss-based management. If you're having 200 euros worth of risk on this trade, you can afford to take this trade on, 5-tick stop. You can do this with 4 contracts, meaning that your payout on the trade to the top of the range, 2,680. Now, take the numbers away. Is this trade any different? Absolutely not. Is this just as good a trade? Yes. The only difference is this false break went marginally further than this one. But the information gained from both of them, the structure in each of those trades is exactly the same. So this trade is just as good as that one. But by having a $200 risk, seeing as you're buying at 55 and your stop is 42, so a 13-tick stop, you got a target in this instance of slightly less than 67. You've got a target in this instance of 66 ticks. So 1 tick less, but a bigger stop. Because of the size of the stop, you're only able to trade a 1 lot. And that then means that you're only going to make 660 euros out of this trade, which is an identical trade virtually. The only difference is you've limited your upside because of the size of the stop, because you've imposed a 200 euro risk per trade limit. Arguably, you could still trade 4 lots on this. You could still achieve the same payout. The risk reward is more than acceptable, 5 to 1. And yes, it might not work, of course, and you could end up down on the day. But the point here being that this is just as high a quality trade as this, but you're not going to get paid anywhere near it because you're trying to limit the risk on the trade, reduce the downside, rather than appreciate the trade for what it is and the likelihood of the upside. So that's where a loss-based strategy does have its limitations. And speaking of risk reward, let's go and have a little look at risk reward. Now, what you have to remember with risk reward is this is a function of a stop and a target. So there's 2 inputs to risk reward. The stop and the target are independent. So what this means is that you cannot define risk reward before taking on a trade. And I know people are often told you should only be looking for trades with a 3 to 1 risk reward, a 4 to 1 risk reward, or whatever number risk reward. That's simply not the case. These are independent factors. So if you define a target and a stop, that will tell you your risk reward. And that's the way you have to approach it. A high risk reward is not necessarily the be all and end all of something. But you can have a very high risk reward if you happen to be able to have a very small stop or a very large target with the same size stop. The crucial thing is twofold. 1, your stop does not influence your target and your target does not in any way influence your stop. The other factor is these things must be decided before you enter a trade. If you're about to enter a trade and you can't tell me exactly where your stop is and exactly what your target is, it's not a trade. It's an entry point. and there is nothing more than that. So you need to know what your stop is. What are you paying for this opportunity? And then, by comparison, what are you gaining from this opportunity to make a judgment as to whether it is worth taking that risk, whether it is worth that stop for the target that you're achieving. That's the way you have to think about it. Risk-reward ratios are just merely a measurement to make something comparable. Right, so let's have a quick look at an example. What we're looking at here then is, how does your entry point determine your risk-reward? Now in this trade, we've got a very clear structure. This is an hourly chart. We've fallen, created a flag, pennant, false break up. Now you get the second shot towards the downside. So the trade is on. The trade is to break the trend, break the low, and there's another smaller level down here at 40. That's your simple trade. So the objective of the trade here is to place your stop up at 70. This is on the shorter time frame. So this here is a 1 minute chart of this candle here. Short time frame. You're going to play the break of the low of the day, as it was at the time, with your stop back up at 70. So we know where the stop is at 70. We know where the target is at 40. Where you enter the trade, even with marginal differences in the entry point, massively swings the risk reward on this trade. If you sell at 68 as it breaks, you get a 14-to-1 risk reward. If you chase and sell at the low, you're now only on a 2-to-1 risk reward. And if you sell at 65 as the market pulls back, you can now achieve a 5-to-1 risk reward. So the risk reward shifts massively just from marginal variations in your entry point. So don't put too much weight on your risk reward. You know what you're trying to achieve in this trade. The target's 40. You've already defined that. Where you get in is what's going to matter here, and that's what's going to determine your risk reward. The whole point being here that the efficiency of your entry matters more than the risk reward you're trying to achieve. And the reason being for that, entry points improve linearly. One tick better, one tick better, one tick better, one tick better. But for every tick better that your entry becomes, better defined as smaller loss if the trade goes wrong, you are also reducing your loss by 1. So you have an exponential change in the risk reward, simply because the closer you get to the stop on your entry, the more payout on the trade with the smaller stop on that trade. So risk reward is influenced massively by the point that you enter the trade. And this all comes back down to the idea that you must have your target and your stop defined before entering a trade. If you go and have a look here, the orange line being your tick profit from any entry point up to the point that it's 1-to-1 risk reward. And then the silver line being your tick loss. Now, to start with, if you enter at 55, so halfway down the move, 15 tick profit, 15 tick loss, 1-to-1 risk reward. As the move goes on, your payout becomes bigger, your loss becomes smaller. And so that is then illustrated by the blue line, which is your changing risk reward on each trade. Risk reward barely shifts down here. And as soon as you start to get above 1, it then exponentially improves. Think you would have at one point a situation where you have basically a 30-to-1 risk reward or 29-to-1 risk reward, where you have an entry at 69 and a stop of 1 tick. So a target of 29, a stop of 1 tick. So it's an astounding risk reward, but you've also got to ask yourself, what's the possibility that it upticked you out of that trade? So the risk reward is not the important thing. The entry is the important thing, because you already know your stop and your target. That's how you improve the risk reward on any trade. Don't look for a predefined risk reward. It's not the answer. Predefined risk reward can limit your upside or give you too big a risk, as I'll illustrate now. Right, if you go looking for a specific risk reward ratio, then what you're essentially doing is you're going to base that on either your stop placement or you're going to base that on your entry placement. So let's, for example, say you wanted a 3-to-1 risk reward. Now, if you base this on a stop at 70, so you say, right, that's where my risk is. If you sell at 68 with a 3-to-1 risk reward, so you sell up here, 3-to-1 risk reward, you're going to end up getting out of this trade at 62. So that's where you're going to get out if you sell at 68. Now, so these would be your exits, the red lines. You sell at 68, you're way off the mark. You're exiting just as it breaks the low. Not good enough. If you sell at 65, you're going to exit down at 50. Again, nowhere near the break of the low. So that 3-to-1 risk reward is limiting you, because what you're doing is saying, well, if I'm going to risk 5 ticks, I'm going to take 15. Yes, but you could take an additional 10 on that as well, and you're not doing it. If you sell at 60, then your target becomes too far by having a 3-to-1 risk reward, because you're now looking at 30 ticks. And the point here being as well, that if you sell at 60, the target is getting smaller, yet you're looking for more because you've given yourself a bigger stop. So what you're doing is you're allowing your stop to influence your target, and these things are completely independent of one another. If you go the other way and you say, I want a 3-to-1 risk reward based on a target of 40, what this does is it influences your stop. So now, if you sell at 68, as the market breaks, you end up putting a stop at 77. Now, if this gets back up above 68 and up to 70, you know you're wrong. There is absolutely no reason to pay another 7 ticks to find out you're wrong when you already know you are. If you sell at 65, you'll stop 72. Again, unnecessary. You don't need such a big stop. If you sell at 60, your stop's at 67. So now what you've done is essentially put yourself in a position where you sell it at 60 and you get stopped out without being wrong. And all of that is because what you've done is said, well, I want a 3-to-1 risk reward on this, and if I'm only going to get 20 ticks, I can only give myself 7 ticks worth of stop, which means you're highly likely to get stopped out on that one, putting yourself in problems. This is the danger of trying to apply a set risk reward to a trade. You need to look at this in a different way, and you apply it from the perspective of risk reward is there just to inform your judgment of a trade as opposed to anything more than that. Right, next up, we're going to look at volatility and how volatility adjusts your risk reward, but also adjusts another key factor of risk management, frequency of opportunity. So onwards to volatility. Okay, so volatility. The difficulty with volatility often is that the solution to volatility is don't trade it. And that's what you get told a lot of the time on events in particular, or particularly high volatility markets. You're told don't trade these things. Now, this has to be tempered when you're thinking about risk management in terms of what does volatility bring you and how do you deal with that. Now, what volatility will bring, and something that's often misunderstood or not recognized, is that volatility brings more opportunities. There is more action in the day, there are more things going on, there are more chances to find trades. What this means is that over time, the higher frequency of trades smooths the variance in performance of an individual trade. Now, the thing that you need to be aware of with volatility is, of course, tick risk goes up. The number of ticks that you are going to risk on any individual trade is going to go up with volatility. That makes sense. At the same time, though, tick payout will also go up. Now, you can control your tick risk and adapt your tick risk so that, yes, it will increase in the number of ticks you are risking, but not at the same rate that your payout has to increase. And with higher volatility, markets are more inclined to run, i.e. to overshoot things, to put in a larger move than you might originally have expected. And this is where you need to recognize that actually volatility provides a lot more opportunity. What you've got to do is you've got to deal with this tick risk increase. Now, the simple solution to this is reduce the size that you use. This is obvious. If you're going from, say, risking 5 ticks on a trade on average to now having to risk 20 ticks on a trade, your size to maintain the same monetary risk is going to have to decrease by 75%. That makes sense. And the reason being that your stops are going to increase. All of this is pretty simple. If volatility falls, and this is where it becomes a little bit tricky, because when volatility falls, of course, your tick risk reduces. Markets are not moving in such large ranges, therefore you are taking on a smaller amount of risk number of ticks. You can increase your size effectively, and you need to do this to maintain the earning capacity that you had when volatility was high. The difficulty you have there is when volatility is high, let's say you get offered 20 trades in a day, volatility falls, you may now only get 5 trades in a day. So not only are you getting less trades, you are also getting smaller payouts on trades as well. That's what makes it very difficult, because now you have to increase your size quite significantly. Just to take account, let's say, of the number of opportunities, you need 4 times the size. And to then take account of the size of payout difference, you may well have to increase your size another 4 times. That's where the difficulty comes. And the problem that you also face when volatility falls, and not to say that lower volatility is entirely bad, but when volatility falls, you have to also take account of the fact that variance increases. I'll explain this in the next slide, how to understand variance based on the number of people trading. What you have to do is you have to work out the type of volatility that works for you. That's really crucial to knowing whether it's the right time to be trading or not. Just because volatility is low, yes, it reduces your tick risk. But low volatility doesn't necessarily facilitate actual increased earning capacity. And so if that is the case, yes, it's costing you less if you lose on a trade, but you're losing on trades without the ability to actually make that money back. So whilst your losses don't feel so painful, and monetarily they're not, the ability to actually recoup any of those losses is very difficult. And so you have to take account of both sides of that equation. To try and explain this a little bit more, I've got a couple of examples of this in a moment, is the difference between what you would call quiet markets, low volatility markets, and higher volatility, busy markets. And this all comes down to the law of small numbers for low volatility markets. When I say the law of small numbers, this relates to participants and number of trades that you're going to get. Now, when volatility is low, participation falls, number of trade opportunities falls. What this creates is greater variance, greater chances for extreme situations to occur. Take a coin toss example, very simply. You toss a coin 10 times, theoretically, if you said tails every time, you would win 5 of 10. But with only a 10 set sample, quite possibly and quite frequently, you will have a situation where you have an extreme and you get 9 out of 10 going for tails every time. And what that's to do with is that the average applies over a large number. But the variance in the short term means that you can end up with very extreme scenarios. You could end up losing 9 times out of 10. Because what is typical won't always play out. There's not enough chances to smooth that more typical trade. Also, when a market is not doing very much, if business needs to be done by somebody, when participation is low, they will drive a move. But because of the low volatility, this will not necessarily create continuation of movement. So it will not then beget more opportunities to make money back or to increase earnings. That's the difficulty with low volatility. The way to deal with this, irrespective of the size that you're trading, but the way to deal with low volatility is to zoom out. Get yourself looking onto larger timeframes, because there are not enough people to create consistent action in shorter timeframes. So get yourself onto a 60-minute chart, something like that, so that what you're able to do is you're able to spot where genuinely the bigger opportunities may well be coming. And when I say bigger opportunities, I'm talking about an opportunity that is bigger than the recent sort of intraday movement, because the bigger moves where something significantly changes, that then is a move that you can trust that little bit more, because participation will come in, let's say, as you move out of a range that you've been recently trading in. When you get busy markets, and this is why high volatility is not necessarily bad. Okay, with volatility, busy markets, then you get, on average, more consistent performance. Not because suddenly you get more trades right, but you have more opportunities to be less influenced by variance. So yes, you will take a higher number of losses on a day, but you're also going to have a higher number of winners on a day as well. That's what makes the difference. It doesn't change the performance necessarily or the win rate in any way, but it gives you more and more opportunities. And this law of large numbers means that you get less variance in performance over time. What you also get, because of the larger number of participants in the market, is you get a more what I call pure auction. So this is down to the way a market trades. When you have more participants, people are more reactive to what's going on, and people see the same things. And because you have a lot of people seeing the same things, then the market is less likely to get driven by one person individually, because there is such a large number of people who are there to, say, counter that move. Take, for example, let's say you have a market that falls, breaks a support, and pulls back to the support. When you have a very, very high volatility market, this support break is well recognized by many people. The shorter timeframes become more important because of the fact that people's situations change so much more frequently. So as this level breaks, now people are very aware of the break. More people are going to play the retest of the level as a short. So on average, you get a more predictable reaction, a more pure reaction, because you can be confident that it's not just you looking at that and you may be the only person that day looking at it because there's so few other participants. There are a lot more people and they're going to be looking at similar type things. So you get this much more pure auction where the market does more consistently expected things. What it also does for you is it gives you greater clarity of movement. When a market hits a level, yes, of course, you could be wrong, and this will go back through the level and the market will go up. But you know very clearly and very quickly whether you are right or you are wrong, meaning that you can then move on to the next trade. And you can move on with confidence that what you actually decided was your point to be wrong is where you're wrong, and then it begets a new trade. Whereas with low volatility, because of the lack of participation, levels are much easier to be fudged, as I would call it. And so what can happen is you go and sell the level, market moves up, it moves back through the level, it moves again, you get stopped out, and then it meanders down. And it's very hard to know that you're necessarily wrong at that point where you get stopped out. And this could be simply because of the fact that there's very few participants, somebody pushes the market up, it stops you out. That's the difference. Whereas in a high volatility market, you get more sort of reaction. If the level breaks, and indeed you do get stopped out, that's fine, because you will then get a more consistent and more clear reversal, more confident. Once you're right on a trade as well, the market shows you this much more clearly. The pace will come in if the market does continue onwards to the downside. You will see more action. And this then helps you actually have conviction in trade. So yes, of course, the tick risk that you are going to take when volatility increases is always going to be there. But your conviction in trades and your ability to get a trade right more frequently and have conviction in that goes up. And we'll talk about the combination of risk and probability a little while down the line. So let's go and have a look at a couple of examples to try and explain this and illustrate this a little bit better. What we've got here, this is what you would call a low volatility market. It is a market that on the whole has periods, this is the S&P, and I'll give another S&P example, cash session 1 minute chart. What this is a period of low volatility. The entire range for the day on the S&P in this example is around about 30 handles. That's pretty small. But within that, the important thing to be aware of is the variance. You get these one moments of action, one sudden move, and the market then rotates within this. Very, very small movements in here. Market moves higher. This is only 12 handles worth of range. This, I think, is a viable trade. That's perhaps your one viable trade for the day. So you get quick breakout. That makes a lot of sense. But the payout on this trade is relatively small, 6 handles. And after that, we sit in a very, very small sideways range. So what you've got to think about here is if you could take the extremes of the range, sell from the very top, buy it at the bottom, you can make 5 handles. But look at the number of opportunities you actually get to do that. You can buy the bottom once, because you're not going to sell the top, you don't know it's the top. You can buy the bottom once, you can buy the bottom again, and you can get out at the top once. So in fact, you get one trade there that's worth 5 handles in reality. And the thing you have to think about here is it's not worth buying here because your payout is not worth it relative to your stop. So you get a very, very small opportunity. And the problem you have then is variance. One trade here doubles the range. And that's one move that comes straight back and then sits straight back into the range. This means that you have one opportunity to make money, one opportunity to lose your money, assuming you're going to sell the top of the range on the way back, and no opportunity to make that money back. That's the problem with low volatility. You don't get enough chances to make your money, and you are at the mercy of sudden actions that can very quickly erase gains because the gains are so small. So whilst it feels quite safe and feels comfortable because the market is not erratic and moving around quickly, it's at the mercy of a sudden change, which then means that you are pushed out of position, you lose money, and you can't then recoup it. Now, when volatility increases, you get much more consistent action. Sudden moves, yes, absolutely. Very, very similar type action, sideways move, breakout, reversal. Sudden moves whilst you will likely lose here, will give you the opportunity to make your money back, because it then creates a situation where you get more and more action, more and more trades, more and more opportunity, more chance to then smooth that loss out over time. Also, low volatility, this range is now 15 handles, meaning that you do have a little bit more chance to actually take something out of it. Yes, of course, you get in to take more money out of the trade for one, but your stop doesn't have to be that big. In the same way that with the previous example, if you're trading a five big tick range, realistically, you're still going to need probably a 2-handle stop just to make sure that if it ticks out the range, it's not just a quick tick down and that's it. So in the previous example, you're taking a 2-handle stop for a 5-handle risk. So your risk on the trade is 40% of your potential payout. Here, you may need slightly bigger, 2-3-handle stop. So let's say you have a 3-handle stop, but you're getting a 15 tick winner. So now you're only risking 20% of your potential payout. What this means then is getting this wrong is much more costly and much harder to recover, as well as the fact that there's less chances to recover it compared to when volatility is higher. The risk is much smaller relative to the size of trade, and also the chance of you getting to recover it is much, much higher. So yes, your tick risk will increase here. Market breaks out. This is going to cost you money. That breakout is 12 handles. It doesn't mean you're going to lose all of it, but what it does do is it means there is now opportunity to trade, because this creates more action. Volatility brings even more participation in. So you get retests of levels here. Market then continues, so you get a decent move. There's a chance to make some more money here. Even if you play the breakout and it doesn't work, that's fine, because you get a pullback. You get another chance. You get a flag. You get another chance. And when the chances come, they will pay you out significantly more than the risk that you're going to be taking on the trade. That's where volatility has its upsides. And this is my point that I was making at the very beginning. It's not just simply about trying to minimize losses. It's about appreciating where there are more opportunities. And if you're getting more opportunities, whilst your losses may be bigger per trade, the chance of you finding more trades that will pay you even more on the upside goes up. That's what volatility is going to help you with. So it's not said there's a strict rule. Of course, the simplest rule is that when volatility increases, size decreases. But when volatility decreases, whilst yes, size needs to increase to maintain the same earning capacity, there is also necessary for the acceptance that lower volatility will actually reduce earning capacity, simply because of the variance that you will get in lower volatility markets. Now, the other thing, and this comes down to actually managing risk in volatility. Excuse me. What you have here then is a higher volatility period. This is an oil market. Well, this is oil. And this is oil with a pretty hefty range. This is pre-cash trade. Oil at this point has moved from $102. The total move here is all the way down to $94.50. So a pretty hefty 750 tick move on the day already. This is very high volatility. That's obvious. Right. So very high volatility means your payouts can be very large, but your risk is going to be much bigger. What we can look at then is an attempted break of the lows. So this is the low of the day from the morning, another test of the low, breakthrough, and then acceleration. The acceleration on that trade will give you around about a 200 tick payout. The difficulty you have here in the basic, so looking at it from a basic chart here, this is a 5-minute chart, is that if you sell the break and it doesn't work, your stop's going to have to be back above here, back above those previous lows. That gives you a 45 tick risk. Now, risk reward is perfectly acceptable. You're going to get paid out 200 ticks, but monetarily wise, tick wise, that is costly. And this is where narrowing down onto a shorter time frame has value in higher volatility markets. With low volatility, the size of that risk tick wise is going to be much smaller, and is a viable risk to say, right, well, you sell the break, that risk may now be 15 ticks, that's fine, my payout's going to be much smaller as well, maybe 50 ticks, maybe 60 ticks. Okay, so the risk reward is relatively similar. Your payout, your cost of loss is going to be smaller, but I would argue the chance of it playing out is lower. So you can still take that much larger potential payout, but reduce the cost of the trade. That's what volatility will give you. This is why in that original graph that I drew, your tick risk goes up like that. Your payout goes up much faster because you don't have to increase the tick risk in the same rate as the payout. Let's go and have a little look. So this is how you can then zoom in and reduce the risk on this trade. And there's a couple of different ways to approach this. Remember, you're going from a 5-minute now to a 1-minute chart. You get in more detail. And what the detail allows you to do is still use the structure of the larger chart, the potential payout of the larger chart, whilst reducing the tick risk on the trade. So there's a couple of options for your entry point. First up, you can sell inside the box. Now the box is the break below the original low at 96.71, which has formed as a little area of support and resistance. And you can sell inside the box, the top of the box being the low of this candle where we nearly reached the level. So you can sell inside the box, which can actually limit your risk down to around about 10 ticks. Once you're through 76.91 and you get this consolidation, you can place your stop here, which reduces your risk down. So now you're potentially looking at a 10 tick risk for somewhere in the region of a 200 tick payout. The payout is still absolutely there because of the wider structure. What you can also do then is play the other option, which is once you break the low, you can play the short on the break with your stop inside the box. We shouldn't be going back up here once the breakout comes. So again, you're refining that risk down. By being more detailed in the trade, you can refine the risk down. Now it doesn't have to be a 45 tick loss. It is much more like a 15 tick loss. Much more acceptable, the payout doesn't change. That's the crucial bit. This is the whole reason why payout goes like that, tick risk goes like that. So you have a point where you have a much greater distance between tick risk and payout. Over time, once volatility really ramps up, the tick risk becomes much higher because it's very hard to control your risk. That's where it becomes difficult. That's where volatility gets to the point where it does reduce payout over time or reduce viability of trades over time. But that's how you can use volatility to reduce the tick risk on a trade. Still won't bring it back necessarily to levels that you might have been achieving when volatility is lower. But the point here being you can get to similar levels of tick risk, yet still get the payout of the higher volatility period. 200 ticks in a minute or two. Sorry, the first minute of that break gives you around about 170 ticks, and then you get the continuation. But around 150 plus ticks in a minute is something you're never going to see in low volatility in oil. 150 ticks over the course of an entire day or even 2 days is still going to be a push when volatility is low. When it is high, the risk per trade can be reduced down still, but the payout is still there. That's where volatility is very, very valuable. Final bit on volatility, and this is a trap that people fall into when they try and standardize risk. When you become accustomed to, and when I say standardize risk, this is standardizing a target as much as it is standardizing a stop. And this is a mistake that many people make, that they look for a consistent amount or what they call reasonable without appreciating shifting volatility. This was a discussion I had with a trader. And it was about a caught in the hole trade. Now, you guys probably understand what I mean by a caught in the hole trade. The idea is to enter at the open with these being your targets. So, some pretty hefty targets up here, running all the way up to 147.42 at the most extreme. So just shy of 60 ticks worth of target. But what the trader said was, plays the trade around 40, caught in the hole, around 45 ticks target. I find this level is okay for me because I don't expect the move to be more than 15 ticks from the 7 a.m. open. Now, having an expectation of the size of move without accounting for volatility is actually reducing your overall payout on trade, because the stop is still not insignificant here. The stop on this trade, theoretically, is down here. The stop is 25 ticks. Now, when volatility is not so high, that stop is going to be much smaller. But you have to take into account the volatility. The previous day's range was 190 ticks. The previous two initial balances were 40 ticks. So looking for 15 is actually extremely limited. Yet you're still taking on the risk of the stop out. The point here being that as volatility goes up, and this is why targets should always be based on reference points, not numbers of ticks or relative to your risk. So if you're risking 10 ticks going for 30 ticks is not a relevant thing. You have to look at it and go, right, where are the potential targets? Here, one of your targets gives you a 56 tick winner to get all the way back to value. And there's nothing to stop you looking for that. You at least have to have staggered targets. And you see here, the trade doesn't play out. It does fail, but it gets up here. It gets up towards 20. So whilst, excuse me, not that one, the second target. So whilst he looks at the trade and feels that actually he's done all right because he took 15 ticks, relative to one, the risk, and two, what you could have got out of the trade, this is a very low performance. The potential of this trade is 56 ticks. To take 15 ticks, you've taken less than a third of the trade. You're taking just over 25% of what you potentially could have got. Now, of course, in the moment when the trade clearly is not working, hits this target and then starts to roll back through 12, yes, you're going to have to give it up. But you've given it the chance. Whereas if you take the trade on and just take 15 and you're out here, you've left a lot on the table. That's something to really be aware of. It's about what you leave on the table. And leaving stuff on the table is as much of a risk in the long term as it is to be stopped out of the trade. Because if you consistently limit the upside on any individual trade, what you end up is a situation where the downside burns. If you consistently take 15 ticks, yet you play the correct stop on this trade, you're putting yourself in trouble because you're losing 25 ticks, yet you're only ever making 15. And when volatility is low, you may struggle to make 15. Yes, your stop would likely be smaller. But because when volatility picks up, you're still only taking 15, your stop increases. So over the long run, your stop will get bigger or your losses will get larger, your payout will stay the same. And over time, that is then going to eat into your profits overall, unless you have an exceptionally high win rate on trade. Whether you have a high win rate or not, there's no excuse to not then try and get paid more when the opportunity is there, when volatility is that much higher. What this all comes down to is trade quality. So that's the next section. How do you make a judgment on a trade based on its quality and use that in your risk management? This is about assigning a grade or an element of conviction into a trade. These are the trades where you can take more risk on. So in terms of your risk management, you take your risk and you say, this is a trade that I'm going to apportion more risk to because it's a higher quality trade. And there are things that make a trade high quality. It is a subjective matter and not something that you can do on a purely probabilistic basis. But it is something that you have experience. When we do debriefing, we're going to look at, well, how do you build that experience and understanding of different trades? Because once you've got that, you now have a situation where you can say, right, this trade consistently is a good quality trade. There's various different reasons that input to the trade making this good quality, therefore I can take more risk on this trade. Context makes a huge difference. I'm going to give you an example in a moment of how context will dictate whether a trade is high quality. Essentially, two trades that are exactly the same can vary in quality because of the context in which the trade or the setup comes about. That's where you have to apportion your risk correctly. Vary your risk based on that quality. So it is a subjective matter. And like I said at the beginning, I'm not going to try and make this about statistical risk management. This is the reality of day trading. The subjective risk management in the moment, in the action, what do you do? Right. So one way that you can assign value to a trade is by taking trades from your playbook. Standardized plays, setups, caught in the hole, for example, that you consistently take. And you can grade these trades essentially. You can grade them on your conviction that they work, i.e. the win rate of the trade over time. You can also grade them on the typical risk reward. And we'll do a little bit of this on strategy development. So you can look at it in that respect and be able to assign a value to the trade, if you will. People do them in scales of 1 to 10, A, B, C, D, E, etc., etc., etc. And then you define whether you really want to take that trade on based on how good the quality of the trade is. Quite simply, the higher the expectation of a trade or the higher quality that you assign to a trade, the more risk you should be willing to put on it. And in terms of your risk, this could be a case that you put 50% of your daily risk on one individual trade. If you feel that this is the best opportunity you're going to get for the day and it's a trade that you really understand well, this is where you should be taking more risk. Again, flip it round. Not taking the risk there means that you forego a payout on something you're very confident of, rather than sitting there waiting for an opportunity to come which may not come. Right, the other thing is context. Context is so vital, and this is why you can't make risk management decisions based on just simple probability of a setup working. If you look at every example you've got of a reversal trade, you can work out the probability of that trade working. But what you're trying to do from a risk management perspective in terms of assessing the quality of the trade is not the probability, because that is an average over time. You are looking at the propensity of the trade to work in this moment. And that comes down to context. That comes down to the situation you are currently in. And that allows you to say, if this trade on average works 70% of the time, when you consider this from a propensity basis on the context that you have, you can say whether this is one that is going to fall into the 70% or one that will fall into the 30%. That's what you're trying to do. If you believe it's in the 70%, now you're being able to say to yourself, I actually think there is maybe a 90% chance that this is one of the 70%. So you're now effectively shifting the overall probability to say there's only a 10% chance that it's one of the 30%. There's a 10% chance that I'm actually going to lose on this trade. In which case, absolutely, you should be taking more risk and you should be going for this trade. The payout matters as well, and that's something you've got to consider on the trade as well. So let's go and have a look at an example. Now, on the face of it, this is a dead simple play. This is an IB break after a failed auction. So the play here, as you will have known from profile week, is that you have initial balance, market trades out of the initial balance, back through the initial balance, you pray the break of the low, you then have to assign a target based on the structure that the market currently has. So this is where context turns this into a really high quality trade. This is the setup. This is the how do you get into the trade. But the context says to you, this is really good. Why? What you have is you've got a range that gets broken away from. That's this double distribution day. We then have a balanced inside day with a bad low and a close at the low. So now we have a situation where you've got at least scope to break the low of the previous day. And in doing that, it gets you inside this range, which now means that you've got the potential to sweep the entire range down. So this now means that this has become a very high quality trade. Not because of the probability that when you play an initial balance break, you get a move of X number of ticks, but because on playing this initial balance break, you've got the potential of a very big, very clear payout on the trade. There is a high scope to this trade. And it should trigger a liquidation move, giving you a move to the VPOC of the range, the low of the range 07, and then arguably beyond that, down to 88. So that's what the trade offers you. This is a really high quality trade. And in taking the trade, this is what you get. You would confidently and be willing to take this trade on with more risk. And when I say more risk, you're looking at this, seeing the opportunity to play the break of the IB with more size. Your stop's there. The IB low comes in at around about 55. Your stop is going to go around about 60, just over. So you're taking 5-6 tick risk here. You can increase the size on this trade because the scope of the trade is very high. Early move achieves the VPOC first target. You get a pullback, you get a continuation, and we then achieve the 07 second target and onwards. So this is a trade that, irrespective of what happened, and of course it looks wonderful afterwards and it works, but you could see this coming. The context showed you that there is a lot of scope for this trade. This is high quality. This is where you take more risk on. This is where you look for a bigger target, a bigger expectation of the move. That's how you're going to apportion risk. This would be a trade done with decent size. Now, let's take the exact same setup again. IB breakdown after a failed auction. Exactly the same situation. IB bids up, failed auction, break the IB, move lower. Same trade, basically. Break the IB, nice quick move down. But context is different. This is the day after the one that we just saw. So after that very large sell-off, you know that there is a reasonably higher than average chance that we are going to have a balancing type day. standard profile theory. Post a trend day, you get a balanced day. So immediately, contextually, this is a day with less scope. So whilst this trade in itself is a reasonable trade, and over time is a decent play, the context suggests that this is nowhere near as good or as high quality as the previous day's trade. And this is why you can't just look at a setup and go, probability-wise, this is good. So, scope on this. You can get the break of the IB. This will give you a break of the low, but you're running very, very quickly into support. If we take it back a couple, then we go and look at where we are, this is the support area that you're running into very, very quickly. Now, of course, you could continue on down, but bear in mind, this is looking for a second day trend, which is much less likely. So you're immediately running into support. So the potential of this trade is much, much lower. The scope is so much smaller. So in looking at it like that, yes, there's still a reasonable payout. There's still 25 ticks worth of movement, but you have to approach this in a different way. I wouldn't say don't take the trade on, but the size that you're going to play this with is going to be much lower. And also, the payout you're looking for is going to be much lower. You can't expect the same level of payout here. You're going to have to look at this and say to yourself, right, well, if we can reach that support, that is quite possibly enough here. Whereas the previous one, your expectation, the potential of that trade was so much higher. With the first one, you're looking at this thinking, well, break 60, we've potentially got another 60 plus ticks. Here, excuse me, not break 60 or 58 even, you might be able to get 25 ticks out of this trade. Might. So your willingness to exit the trade is immediately going to be lower. Doesn't mean this is a bad trade. Where a mistake can be made is if you don't appreciate the context and only look at the quality of the IB break. That on its own is good, but the context tells you that your expectations need to be lower, and so therefore this is not as good quality trade. You can reduce the size, or you should be taking less risk on this trade because it's unlikely to be the same type of payout as the previous. Let's go and have a look at a different variation of this. Now, trade quality can change over time. And we'll talk about this more with game planning as to where your edge comes in and where access comes into a trade. What this is a trade looking for a break of multiple daily highs. These all come in at around about 34, and your all-time high at the time was 58.5. That's just up here. So you can already see what the trade is here. The trade is break 34, straight away up to all-time high, 58.5. That's the trade. But that is merely something that you can see. The idea of that trade is good when you're down here, but the quality of that trade is low when you're down here. There's nothing to say at this point that we have to go back up there. And it's very hard to define risk on this. So you're not playing this trade, you're playing the possibility of getting to a point where this trade might happen. But trade quality shifts. What we then get is a move higher, we break the recent high, we produce a small flag. Now, this becomes a much higher quality situation, simply because we now have very few reasons for this to do other things. So it's less about the possibility of even getting here. The possibility of reaching here is very high now. All we've now got to concentrate on is the way that it does it. And that's what's going to give you your high quality trade. So the trade quality changes as this move goes on. You can see the trade already, that's in your back pocket. The quality of it then improves. And this also applies on a shorter time frame. Bring this down onto a shorter time frame, and what you have then is a couple of different things. This is your overnight range. Now your overnight range puts in a high at 29. The level break is 34. Slash 34.5. So now, bring this down, shorter time frame, you can define your opportunity. Right, first opportunity then. You get an initial range, or an opening range just down here, which runs from around about 19 up to about 27. Break of that, break the overnight high, there's your first chance. But this is a conditional move. For the trade to play out, for that high quality trade to play out, you've actually got to break 34. So whilst this is an opportunity, The quality has not yet jumped because you're not over 34, which creates that continuation move. So your size perhaps is going to be smaller on this trade. But what this does for you, and this is why it's so important to recognize that taking losses is not a bad thing. This is a trade that likely you are going to lose on, because exiting here would be a very bad trade. You've got the potential of a much, much larger move. So if you exit here, you've taken this much and you've foregone this much. That's not a good trade. So you're likely here to take a loss. Market comes back down through the box, there's your loss. Not great, you've taken a loss. That's fine, but you now have more information, and more information improves the quality of the trade. As the market falls, one of two things are going to happen here. It's going to fail to keep going, which is what it does, or it keeps going, in which case this trade never becomes viable again, you don't take the trade on. The inability to keep going is now an illustration that this market does not have the energy in it, the willingness to go down. This now improves the quality of the trade. You're taking on current information. Current information says this trade is improving. Now, you've got another chance. You've either got the chance inside the box, or more so, you've got the breakout chance. Gives you a second opportunity. The quality of the trade is now going up based on the information that you're getting incoming. Sellers clearly don't have the strength on this move down. So now, when you do get the break, there's very little reason for sellers to continue to sell. And that improves the quality of the trade. It's a subjective trade, of course, but you're taking that information on. This is now where your risk, again, can increase, because the reasons for this trade to fail are reducing. Here, your risk is not so large. The number of contracts that you trade is not so large because, yes, it could work, but there's conditionality on this. We don't know if it's actually going to break the level. There's nothing to confirm at this point that we're going here because there are still things in the way. But as information grows, the quality of the situation improves. This is a trade where you should actually be taking it on with more size. This would be something that people often struggle with, because let's say you lose $200 on this trade as you take the loss. A lot of people will not then be willing to say risk 500 on this trade, despite the fact this is a much higher quality trade. And one of the things that makes it a high quality trade is the fact of this loss giving you information to suggest that this is now a viable move. So taking losses are not a bad thing. Your probability of being right first time is not as good as it is as once you've got more information. That's a real important thing to understand with trade quality.